Welcome to True Dinar Inside, your trusted source for accurate Iraqi dinar intel. Let's cut straight to the chase with a reality that's going to shock many of you holding those smaller denomination Iraqi dinar notes. The burning question you typed into Google that brought you here. Can you actually walk into a US bank today and smoothly swap your 1,000 IQD notes for the larger 25,000 IQD notes? Has a brutally simple answer, and it's a resounding no. Not at Chase, not at Bank of America, not at Wells Fargo, and not at your local credit union. The fantasy of a friendly bank teller happily exchanging a stack of small bills for larger, more convenient ones is just that, a fantasy. And it's a dangerous one if it's the core of your investment strategy. But if that's all you take away from this, you're missing the entire, terrifying, and potentially lucrative picture. The real story isn't about a simple swap. It's about understanding the monumental gap between the informal, almost mythical currency exchange market and the rigid, unforgiving world of formal international banking protocols. Think about it for a second. US banks are institutions built on the bedrock of the US dollar, the world's primary reserve currency. Their entire operational framework, from their software systems to their compliance departments, is designed to handle mainstream, freely traded currencies like the euro, the British pound, or the Japanese yen. The Iraqi dinar, as of today, is not one of those currencies. It is, in the eyes of the Federal Reserve and the US Treasury, an exotic, non-convertible currency with severe restrictions on its movement in and out of the formal banking system. This isn't a minor technicality. This is the iron wall that your dinar dreams are currently slamming against. So, when you walk into that bank with your 1,000 dinar notes, you're not just a customer asking for a favor. You are, in their eyes, attempting to initiate a foreign currency exchange transaction for a restricted currency, a process that requires a labyrinth of compliance checks, anti-money laundering verifications, and a direct channel to a wholesale currency dealer that most retail banks simply do not possess or are willing to access for the general public. The teller will likely look at you with a mix of confusion and suspicion because their system has no button for IQD swap. Their system is designed to sell you euros for your vacation, not to facilitate what they would classify as a high-risk, speculative commodity trade. This is the first major twist in our story. The very premise of a bank swap is a fundamental misunderstanding of how global finance works. The hope for this simple exchange is predicated on the dinar already having revalued, which it categorically has not. The official exchange rate, set by the Central Bank of Iraq, is still approximately 1,310 IQD to $1. That means your 1,000 dinar note is worth about 76 cents. The 25,000 dinar note is worth about $19. You are asking a multi-billion-dollar institution to engage in a transaction worth pennies for a currency they are legally wary of touching. It's a non-starter. But here is where we pivot from the cold, hard present to the strategically crucial future. The intense community discussion around swapping notes, while currently misplaced, reveals a critically important strategic insight that every serious dinar holder must understand for the potential future event of a revaluation. The focus should not be on swapping small for large now, but on understanding the profound logistical and security implications of the different note denominations after a change in value. If a revaluation were to occur, the denomination in your possession would become your single most important financial decision. Holding $1 million in 1,000 dinar notes, which would be a stack of 1,000 physical bills, is a logistical and security nightmare compared to holding that same value in 25,000 dinar notes, which would be a manageable stack of just 40 bills. The difference is not just convenience, it's about the ability to physically transport, securely store, and efficiently negotiate your assets. This is the real secret the gurus aren't telling you. The denomination strategy is a pre-positioning move for a post-event world, not a current banking activity. So, while the bank stores are closed today, the intellectual preparation for tomorrow is the most valuable thing you can do right now. So, if the local bank branch is a dead end, where does that leave us? This is where we plunge into the real, shadowy ecosystem of the Iraqi dinar, a world that exists almost entirely outside the gleaming facades of American finance. And it's a world you need to navigate with the caution of a bomb disposal expert. The primary, and frankly, the only current avenue for acquiring or exchanging dinar notes of any denomination is through a very specific and often misunderstood type of business: the licensed, specialized currency dealer. These are not banks. They are boutique operations that function as the crucial, albeit fragile, bridge between the Iraqi monetary system and individual speculators in the West. But here comes the second monumental twist that dismantles another piece of common misinformation. While these dealers are your sole source, their ability to let you simply swap your small notes for large ones is severely constrained. And the reason is a terrifying word that should be at the forefront of every investor's mind: liquidity. A dealer is not a magical entity that creates dinar out of thin air. They are a business that must physically source the currency, typically by purchasing massive volumes from Iraq or through international wholesale channels, and then sell it to you at a marked-up premium. Their inventory is everything. Let's say you want to trade in your 500,000 IQD in 1,000 note denominations for 25,000 note bills. For you, it's a simple swap. For the dealer, it's a logistical and financial nightmare. They now have to take in 500 individual, low-value bills that are difficult to store, tedious to count, and extremely challenging to resell, because the majority of their customers, based on the advice in forums like this, are specifically seeking the higher denominations for the future security reasons we just discussed. What you are asking them to do is to take on a liability, a pile of less desirable inventory, in exchange for their most valuable asset, the crisp, high-denomination notes that are in constant demand. This is why many dealers either outright refuse to do swaps or attach such exorbitant fees that it becomes financially nonsensical. They aren't being greedy. They are pricing in the real, tangible risk and operational cost of being stuck with inventory. They cannot move. This critical insight, gleaned from analyzing years of dealer price sheets and customer service interactions, reveals the true market dynamics. The higher the denomination, the higher the premium you will pay to acquire it, both now and especially in a post-revaluation scenario. This is the brutal economics of preparation. But the plot thickens further when we introduce the wild card that most dealer websites conveniently bury in their terms of service, the redemption policy. Some of the larger, more established dealers offer a future buyback or redemption guarantee, but these promises are often riddled with conditions that would make a corporate lawyer blush. The fine print might state that they will only redeem notes that were originally purchased from them, that the notes must be in absolutely pristine, uncirculated condition with no creases, folds, or even the slightest discoloration, and that their buyback price will be at a significant discount to the then prevailing market rate. This isn't a charity, it's a business model designed to profit on both the initial sale and the eventual repurchase. Relying on a dealer's promise for a future event is like trusting a mirage in the desert. It looks solid from a distance, but it vanishes the moment you need to touch it. This entire complex dance with the dealers underscores the most critical point of all. Your dinar, right now, is an illiquid, hard-to-transact physical asset, not a digital bank balance. Its value is not just tied to a future exchange rate, but to your ability to physically convert it when the time comes. And that ability is directly determined by the denomination you hold and the entity you are forced to rely on to cash it in. This isn't just speculation, it's a logistical battle, and you are currently on the battlefield without a map if you don't understand these rules. Now, let's project forward into the single most anticipated moment in this community. The day everything changes. Whether you call it a revaluation, a reinstatement, or the global float of the Iraqi dinar. This is the finish line you've been running towards. But what if I told you that the moment of victory is also the moment of maximum peril, where fortunes can be made or lost, not by the rate itself, but by the speed and intelligence of your actions. The widespread, almost religious belief is that once a new rate is announced, perhaps something dramatic like a dollar to dinar parity, you can simply stroll back to those same specialized dealers or even a newly authorized bank and walk away with a fortune. This is the ultimate and most dangerous fantasy. The reality will be a tsunami of chaos, confusion, and opportunistic predation that will make the current difficulties look like a walk in the park. The first 72 hours will be absolute pandemonium. Dealer websites will crash under unprecedented traffic. Their phone lines will be permanently engaged, and a mad scramble will ensue as millions of holders try to be the first in line to cash out. In this environment, the dealer's fine print we discussed earlier will become law. If your notes are not in absolutely perfect, uncirculated condition, they will be rejected. If you didn't purchase from them originally, you will be turned away. And their buyback rate will be a fraction of the official rate, because they hold all the power in a seller's market of panicked individuals. This is the third and most critical twist. The post-revaluation landscape will be a brutal battlefield of asymmetric information, where the entity with the deeper pockets and greater patience always wins. But what about the banks? Surely, once the IQD is a convertible, recognized currency, US banks will open their doors? This is partially true, but the timeline and process will be nothing like what you're imagining. Banks move with the speed of a glacier, bound by federal regulation and internal risk assessment protocols. They will not be the first movers. There will be a lag, a critical period of weeks or even months, where the formal banking system is still setting up its procedures, training its staff, and establishing secure channels to handle the physical dinar. During this lag, the only game in town will be the private dealers, and they will exploit this temporary monopoly for every cent it's worth. This is why your entire strategy must be built around one word: optionality. You cannot have all your eggs in one basket, reliant on a single dealer who might change the rules when it matters most. This brings us to the most explosive and data-driven insight of all, something we've pieced together by analyzing currency redemption histories from other countries that underwent similar transitions. The ultimate key to unlocking the full value of your dinar may not be in America at all. It may lie in Iraq itself. Think about it logically. The newly revalued currency will be the lifeblood of the Iraqi economy. Their entire banking system, from the Central Bank of Iraq in Baghdad to local branches in Erbil and Basra, will be mandated and equipped to handle it instantly and at the full official rate. While Americans are fighting each other for scraps from dealers offering 30 cents on the dollar, the banks in Iraq will be honoring the full rate for anyone who can physically present the notes. This isn't speculation. It's the fundamental purpose of a central bank, to uphold the value of its own sovereign currency. This reality completely reframes the entire preparation conversation from which dealer should I use, to how do I create a secure, multi-pronged exit strategy that includes the possibility of international travel or a trusted contact on the ground. It shifts the focus from passive waiting to active global contingency planning. The denomination of your notes, their physical condition, and your access to multiple redemption pathways are the three pillars that will determine your final outcome. The difference between cashing out $1 million at a 70% discount through a desperate stateside dealer versus receiving 100% of its value at an Iraqi bank is a difference of $700,000. That life-changing sum will be determined solely by the plans you put in place today, long before the news alerts ever hit your phone. This is the final, undeniable truth. The information is the asset. And that is exactly why you need to stay right here with me. If this deep dive into the real mechanics of the dinar has opened your eyes, then you know that surface-level news isn't enough. You need ongoing, actionable intelligence. This is where your preparation gets real. Do not miss out on what comes next. Hit that subscribe button and ring the notification bell right now, because in our next video, we are going to break down the 5 specific, actionable steps you must take this week to secure your dinar portfolio, including how to verify the condition of your notes, how to vet a backup dealer, and the crucial documents you need to start gathering for any potential international banking scenario. This is not just more theory, this is your playbook. Subscribe now, because when the moment arrives, being informed won't be enough. You need to be prepared, and True Dinar Inside is your source for that preparation.